Ladies and gentlemen, our next speaker is none other than Mr. Fali Nariman. Mr. Nariman is a senior advocate, Supreme Court of India. He is a constitutional law and arbitration expert and institution in himself. Mr. Nariman is joining us virtually today. While Mr. Nariman does not need any introduction, I would like to briefly mention few points about him. Mr. Nariman has practiced law for more than 70 years, initially in the High Court of Bombay and since 1972 in the Supreme Court of India. He has held several prestigious positions like Additional Solicitor General of India, President of the Bar Association of India, Vice Chairman of the International Court of Arbitration of the ICC Paris, President International Council for Commercial Arbitration, and currently Honorary Chairman International Council for Commercial Arbitration. Chairman of the Executive Committee of the International Commission of Juris Geneva, and currently Honorary Member of the International Commission of Juris Geneva. Mr. Nariman has also been awarded with Padma Bhushan and Padma Vibhushan. Mr. Nariman will be speaking on the topic Viewing GST from a Constitutional and Cooperative Federalism Lens. Over to you, sir.
I have spent the past hour, as you have, very usefully listening to a very practical talk by Mr. Pratik Jain. I was very impressed. And the talk was about where the shoe pinches in GST. And I gather that it pinches quite a bit. I wish you had some representative of government, someone from the Revenue Secretary's office, who could have provided the government's point of view. It might have been beneficial to us all. My talk in this GST summit is more structured, more impractical, if I may say so. It is about constitutional aspects of GST, on which I have had the benefit of much learning from my very good friend, V. Lakshmi Kumar, as well as his talented daughter. For many years now, I have always believed that what Lakshmi Kumar doesn't know about taxation is just not worth knowing. The highlight of this annual summit, ladies and gentlemen, I must tell you, is not my speech, but the talk that you will hear this evening on bracing GST for the digital economy. Lakshmi Kumaran's talk this evening will definitely go over my head. But for all of you present and listening in, I request you not to miss it, because we, all of us, at least you definitely, will have shortly to live an entire lifetime run only on digital economy. Before dealing with GST, let me place the topic in its proper perspective and setting, since it was something not thought of nor contemplated either in the Constitution of India 1950 nor in the 105 amendments effected to it thereafter. Article 1 of India's Constitution declares India is a union of states, and this makes India a country with a federal form of government. Federal simply because it conforms to the definition in the dictionary. In the Oxford Dictionary, federal is defined as that form of government in which two or more states constitute a political unity while remaining independent in their internal affairs. And federalism is the advocacy of this principle. Yes, ours is a federal republic, but with a distinct centrist bias, since the message up front in the preamble of our Constitution is to uphold the unity and integrity of India. The Union of India today consists of 28 states and 8 union territories. But this is only after some strategic maneuvering on the part of the government of the day, by which the large erstwhile state of Jammu and Kashmir, that included Ladakh, was cut down to size and remains divided into 2 separate union territories, the Union Territory of Jammu and Kashmir and the Union Territory of Ladakh. The law by which this was achieved and the procedure by which Article 370 of the Constitution has been revoked has been challenged way back in 2019, and regrettably it still awaits the decision of a constitutional bench of the Supreme Court of India. This Constitution of ours, the Constitution of India 1950, when it was enacted, it was divided into 22 separate parts. And after a spate of as many as 105 constitutional amendments, very surprisingly, it still remains divided into 22 separate parts. The lecture this morning is primarily concerned with 2 of those parts, or perhaps 2 chapters in those parts. Chapter 1 of Part 11, Legislative Relation, and Chapter 1 of Part 12, Finance. Chapter 1 of Part 11 sets up the legislative relations between Union and the states, and the principal provision in it is Article 246, which sets out the subject matter of laws to be made by Parliament and the subject matter of laws to be made by state legislatures. Parliament has exclusive power to make laws with respect to subjects referred to in the Union list, that is, List 1 of the 7th Schedule. And this power also includes the power to make laws with respect to taxes, duties and rates that are mentioned from items 82 right down to 92B in the Union list. The power extends to make laws with respect to taxes on the sale or purchase of goods, goods being now inclusively defined as including all materials, all commodities, all articles. But 246 doesn't end there. It then goes on to provide that every state legislature has the exclusive power to make laws for the state or any part thereof with respect to matters enumerated in the state list, that is List 2 of the 7th Schedule. That power also includes the power to make laws with respect to taxes, duties and rates, but only those set out in items 46 to 63 of List 2. Now, to top it all, there is also a concurrent list in the Constitution, List 3, where both the Union, Parliament and the state legislature have power to make laws with regard to matters enumerated in List 3. But, and this is a very important but for purposes of the present lecture, in List 3, in the common list, there are no matters at all relating to taxes, duties or rates. With the liberalization of the economy in 1991, India's tax regime experienced manifold problems. And in August 1991, the government of India appointed a committee under the chairmanship of Professor Raja Chaliya. Raja Chaliya, I hope all of you will know, and if you don't know, please remember, he was the most distinguished economist in my time and has been referred to by many as the father of tax reforms. Now, Professor Raja Chaliya committee had recommended for the first time the introduction of taxable services. Not tax on service, but taxable services. It was leviable at a flat rate of about 5% from July 1994 till 2003, and then increased from year to year to 15% up to June 2017. But only 3 types of taxable services were included. One, to an investor by a stockbroker in connection with sale or purchase of securities on a recognized stock exchange. 2, to a subscriber of a telephone connection. And 3, to a policyholder by an insurer carrying on general insurance business. A pittance, you will say. And taxable service was leviable only by the Union of India. The Finance Act 1994 made detailed provisions for the levy and collection by the Union of India on this very restricted taxable service. In 2003, a constitutional amendment was added in our Constitution 268A as to how service tax that was levied by the Union was to be collected and appropriated by the states. But 268 is now deleted after the advent of GST. Entry 92C was then inserted in the Union list in the 7th schedule by the 88th Amendment Act of 2003 that expressed an intention to tax a wide range of services. But this never materialized because the enforcement date for tax on services was never notified. India was not yet ready for a general service tax regime. But in the chapter on finance, there were and there are 2 very important articles which you must know, and they are basic to all schemes of taxation. First, Article 265, which says no tax shall be levied or collected except by authority of law. In England, the principle of tax without representation goes back to 1215, that is 1215, when King John was King of England, goes back to Magna Carta. And the principle of no taxation without representation is embodied up front in Article 265. It's a very important principle for everybody who deals with tax. Under our Constitution, not only the levy, but also the collection of tax must be under the authority of some law. And the procedure for doing this is provided for in several articles in our Constitution. The levy cannot be by mere resolution of Houses of Parliament or of state legislatures. It cannot be by executive action. It cannot be by administrative instruction. It can, of course, be imposed by subordinate legislation, but only if there is express statutory authority for the charge. Again, the words without authority of law in Article 265 mean without authority of a valid law. An invalid law, an unconstitutional law, or a law enacted by colorable use of legislative power will not justify the levy or collection of a tax. And please note, there can be no intendment in the levy of a tax. It has to be specifically levied by a clear statutory provision. In India, whilst there can be a purposeful construction of a legislative provision, there can be no purposeful interpretation of a provision imposing a tax, a very important constitutional provision for all of you to know. The power to tax is an essential attribute of sovereignty, but at the same time, no pecuniary burden can be imposed by whatever name called, except under clear and distinct legal authority. Because the imposition of a tax is both sovereign as well as a constitutional function. The residuary powers clause in our Constitution, Article 248, stated and states that Parliament has exclusive power to make any law with respect to any matter not enumerated in the state list or in the concurrent list, and this power specifically includes the power of making any law imposing a tax which is not mentioned in either the union list or the state list. Now comes the change with the GST, that is, with the Constitution 101st Amendment Act from 8 September 2016, but effective only from 1st July 2017, and that is why your 5-year period was celebrated on 1st July 2022. In Part 11, Legislative Relations between Union and States, in Chapter 1, Article 246A was added. And this is really the heart and soul of the GST. The marginal note reads, special provisions with respect to goods and services tax. And goods and services tax as a composite item is now specifically defined in Article 366(12)A as meaning any tax on the supply of goods and services. No longer a tax on the sale or purchase of goods, but a tax on the supply of goods and services. But the opening words of Article 246A are important. Notwithstanding anything which is already contained in Article 246 and 254. Therefore, not only Parliament, but every legislature of every state, which includes a union territory, also has power to make laws with respect to goods and services tax. A tax that can be imposed both by the union and by the states, except that Parliament retains to itself the exclusive power to make law with respect to goods and services tax, where the supply of goods and of services or both takes place in the course of interstate trade or commerce. Services is now defined in the constitutional definition provision, Article 366. It says services means anything other than goods. And anything means anything under the sun. Take an absurd example. Both Parliament and state legislatures could conceivably tax the cutting of hair on a man's head in a hair cutting saloon. This would be a service tax. And it could, if it so choose, also tax the accumulation of human hair in hair cutting saloons, which would be goods, because human hair in bulk has a market. And so a tax on hair as goods could conceivably be imposed. Of course, neither hair cutting nor human hair when cut is taxed at present, and it won't be taxed in the foreseeable future. Hopefully not. But extreme examples serve to illustrate the width of a provision. Under GST, services now includes anything on earth other than goods. Also note that with the provision now introduced and this is again important, India remains a federal republic. And this is because nowhere in the wide world is there a set theory of federalism. Its concept and practice varies in different democratic political systems in different countries, and also within the same political system in different times. And that is why in the United States of America, the world's oldest democracy, one of its associate justices in that court, famous Justice Hugo Black, a judge who sat there from 1937 right up to 1973, he always emphasized in his judgments, whenever he wrote on federal questions, he would say, it is our federalism about which he was speaking. Federalism in the US and federalism in India are different, because federalism in the Constitution of India is our federalism. As to what should be covered under the new 246A, special provision with respect to goods and services tax, has to be determined by another very important provision, 279A, by the Goods and Services Tax Council. How that is to be constituted, who are to be its members, is provided for in 279A. The provisions of the IGST and the CGST now provide that the Union government is to act on the recommendations of the GST Council, are to be interpreted with reference to the purpose of the enactment, which is to create a uniform taxation system. GST was introduced because earlier different states provided different tax slabs and different exemptions, which contradicted one another. It is the Goods and Services Tax Council as a body that has to make recommendations. And the word recommendation is deliberately used. The recommendations are to be made to the Union and states, that is, to Parliament and to state legislatures. And the recommendations cover a wide range of topics. Taxes, cesses, and surcharges levied by the Union, by the states, by local bodies, which are to be subsumed in the goods and services tax. Next, goods and services that may be subjected to or exempted from goods and services tax. Next, principles of levy, apportionment of goods and services tax levied on supplies in the course of interstate trade or commerce. Next, the limit of turnover below which goods and services may be exempt from goods and services tax. And finally, and above all, and most importantly, the rates, including the floor rates, with the bands within which the goods and services tax is to be levied. At present, the rates on goods and services are in different bandwidths, 5%, 12%, 18%, and 28% for different types of goods and services. But the current bandwidths will keep changing on the exigencies of the case and on the recommendations of the Council. The Goods and Services Tax Council are also required to make recommendations on any other matter whatever relating to goods and service tax as the Council may decide. It's entirely up to them. In particular, the Council should recommend the date on which goods and services tax should be levied on certain specified set of products, namely petroleum crude, high-speed diesel, motor spirit, which is our petrol, and natural gas and aviation turbine fuel. Above all, for discharging its manifold functions, the Goods and Services Tax Council have to be guided by what the statute calls, and this is very, very important, the need for a harmonized structure of goods and services tax, and for the development of a harmonized national market for goods and services. 279A, Clause 6. This is the mantra that the Council must follow. As to how voting is to take place is also provided for. 1/2 of the total number of members of the Goods and Services Tax Council will constitute a quorum. Every decision of the Goods and Services Tax Council is to be taken at a meeting by a majority of not less than 3/4 of the weighted votes, not votes, the weighted votes of the members present and voting in accordance with the principles set out. And the Goods and Services Tax Council must determine all matters of procedure and the performance of its function. And since every decision of the Goods and Services Tax Council is only a recommendation, that is to say an advice, not binding on either the centre or any of the states, the Goods and Services Tax Council is empowered to, and therefore it must, establish a mechanism for the adjudication of any disputes between the Government of India and one or more states, or between two or more states, that is, disputes arising out of the recommendations of the Council. This you will find in Clause 11 of Article 279A. This last provision contained in Article 279A(11) would have been unconstitutional. But fortunately, by some fortuitous foresight, our founding fathers, when they provided in Article 131 that it was the Supreme Court of India that is to have the exclusive original dispute jurisdiction in all and any disputes between Union and the states or between the states interstate, our founding fathers probably realized that conditions may change. And therefore, Article 131 was made to begin with the words, subject to the provisions of this Constitution. Hence the provision now made in subclause 11 of 279 capital A and 11 and 279A, 11 and 12, that the Goods and Services Tax Council shall establish a mechanism for adjudication of any disputes between the Government of India and one or more states arising out of the recommendations of the Council, shows that such a mechanism would not trench upon the exclusive jurisdiction and powers of the Supreme Court of India under 131, only because 131, Article 131, opens with the words subject to the other provisions of the Constitution. Subclause 11 of Article 279A also shows that the recommendations of the Council are not by themselves binding, even though they are made through decisions reached by the requisite majority. Hence, the states are free to raise disputes, even though the particular recommendation had been made by a majority of the Council. And the reason given in a very recent judgment of May 2022 of the Supreme Court of India, a bench of 3 judges, is that this is the essence of cooperative federalism. I've added a footnote to this speech of mine, stating that in a recent judgment of a bench of 3 honorable judges, handed down on 19th May 2022 in Union of India versus Mohit Minerals, it has been unanimously held that the recommendations of the Goods and Services Tax Council are not binding either on the Union or on the states for the reasons there given. The Union of India had pleaded that the recommendation by majority were binding, but the court, the bench of 3 judges, disagreed. But while exercising the rule-making power under the provisions of the Central General Sales Tax Act and the Integrated General Sales Tax Act, governments, central and states, would be bound by the recommendations of the Goods and Services Tax Council. But this binding principle does not mean that the legislative power of Parliament or of state legislatures are in any way fettered. I request each one of you present here to read very carefully the provisions contained in all the subclauses of Article 279A, because in my view, this is basic to an understanding of the goods and services tax scheme. There are also some consequential matters provided for by the Constitution 101st Amendment Act 2016 in respect of tax collected by the Union and by the states under Article 246 capital A. One of the special provisions in Article 279A is for Goods and Services Tax Council to recommend the date on which the goods and services tax is to be levied on certain specified items like petroleum, crude, high-speed diesel, motor spirit or petrol, natural gas and aviation turbine fuel. The other consequential matter that is provided for in respect of tax collected by the Union and states under 246A is that the taxes collected by the Union under Clause 1 of Article 246A, Goods and Services Tax, are to be distributed between the Union and states in the manner provided in Article 270, Clauses 2 and 3. The manner of distribution is set out in 270, but it is important to note that the taxes collected, like all other taxes, do not form part of the Consolidated Fund of India. And the distribution has to be as per the recommendations, again the word recommendation is used, recommendations of the Finance Commission, a different body, which again is a body set up under our Constitution under Article 280. Article 280 is the article providing for the setting up from time to time of a Finance Commission. And the recommendations of the Finance Commission are required to be laid before each of the Houses of Parliament under Article 281 of the Constitution. And if I remember right, the 15th Finance Commission was headed by Mr. N.P. Singh, a distinguished public servant. And the report of that commission is available. Here again, the recommendations of such a highly powered body is almost always treated with due deference by members of Parliament and by state legislatures, but they are not bound by them. Hence, as a direct consequence of GST, which is again a consequence of 246A, the taxes subsumed at the central level would be central excise duty, additional central excise duty, service tax, central sales tax levied by centre and collected by the state, additional customs duty, countervailing customs duty, and special additional duty of customs. And the taxes subsumed at the state level will be state value added tax, state sales tax, entertainment tax, except when entertainment tax is levied by local bodies, octroi, entry tax, purchase tax, luxury tax, taxes on lottery, betting and gambling. To have the whole GST system backed by a robust IT system, Parliament has set up the Goods and Services Tax Network. It will provide and I hope it is providing, front-end services and will develop back and IT modules for states who choose the same. GST is unique because it provides for the concurrent exercise of taxing powers both by the centre and by the state. And the same subject, an unprecedented measure. Both the centre and states are to act in tandem based on the GST Council's recommendations. Another consequential change to the introduction of GST is that the nature of the restrictions already imposed on tax on sale or purchase of goods under Article 286 gets changed. Before GST, Article 286 provided for tax on the sale or purchase of goods where such sale or purchase takes place outside India These words are now substituted, and 286 now reads, no law of a state shall impose or authorize the imposition of a tax on supply of goods or of services or both, where such supply takes place outside the state or in the course of import of goods or services or both into the export of goods or export both out of the territory of India. And so, with its rephrasing, Article 286(2) will now require a formulation of a fresh set of principles by Parliament as to when a supply of goods or services or both, in any of the ways now altered in Article 286(1) are to be provided for. One other consequential provision is that although Parliament has power under the 1950 Constitution to increase any duties of taxes in Article 269 and 70 by a surcharge, mark the word surcharge, for purposes of the Union, that is taxes on the sale or purchase of goods and taxes on consignment of goods and levy and collection of goods and service tax in the course of interstate trade and commerce. Do note that Parliament does not have the power to levy a surcharge for the purposes of the Union for goods and services tax levied under 246A. And yet, and I say this in whispers, Parliament enacted the Goods and Services Tax Compensation to States Act. And fortunately for all of us, the validity of this tax has now been upheld. In the distribution of revenues between the Union and the states is now governed by a special provision, 269A, 2, 3, 4 and 5, which provide that the amount apportioned to a state under Clause 1 shall not form part of the consolidated fund. Where an amount collected as tax levied under Clause 1 has been used for payment of tax levied by a state under Article 246A, amount does not form part of the consolidated fund. When an amount collected as tax levied by a state under 246A has been used for payment of tax levied under Clause 1, such amount shall not form part of the consolidated fund. And lastly, Parliament may by law formulate principles for determining the place of supply, and when a supply of goods or of services takes place in the course of interstate trade or commerce. One last thing. As a consequence of GST, the definition clause in Article 366 has been broadened. Clauses 12A, 26A, 26B have been added. And in particular, 366(12A) now defines goods and services tax as a tax on supply of goods and services except on the supply of liquor for human consumption. And once the GST regime gets stabilized, it is to be expected that petroleum may be included as an item. Petroleum products are already included. 366(26A) defines services, which I have mentioned, as anything other than goods. This is to ensure that no activity remains outside the taxable net. And 366(26B) defines state as including a union territory. A matter of supreme importance, however, is coming last, and that last is, pursuant to the power to tax under 246A, Parliament passed the Goods and Services Tax Compensation to States Act 2017. If this act was not passed, or if the cess imposed by the tax when challenge was not upheld, the entire edifice of GST would have collapsed. It was what I would call the sweetener for the Constitution 101st Amendment going through and being effectuated. The act was conceived and pushed through by the wisdom and eloquence of the late Mr. Arun Jaitley, the then Finance Minister. The Compensation Act of 2017 empowered the central government to generate resources to compensate states for 5 years for any loss of revenue suffered by them on account of implementation of goods and services tax, and therefore imposed a cess to be levied on such goods as recommended by the Goods and Services Tax Council. And hopefully this probably may continue for a year or two more. The act was challenged as unconstitutional, but fortunately, as I said, it has been upheld. And to justify the levy, the Supreme Court merely described it as an increment to goods and services tax. It can be said with some degree of confidence that GST would not have seen the light of day but for the incentive. Let me conclude on an optimistic note. In an article in the Indian Express of 1st July 2022, the 5-year birthday period, the Finance Minister, Nirmala Sitharaman, summed up the entire 5-year period in one sentence. And this is how the sentence reads: GST has been long in the making. It has faced teething troubles, but it has survived the turbulence, emerging better. An eloquent summary for the first 5 years of GST. Thank you very much.
Thank you so much, sir, for your enlightening and in-depth perspective.